There it is. And we are making widgets today. Anybody know what a widget is? You ever hear about widgets? That could be a trivia question today. I learned all about widgets in college, but they don't talk about widgets anymore. Okay, 2 minutes and 2 seconds.
Welcome to Accounting Simplified. Let's look at the ways in which costs flow through an accounting system. This is a widget. The cost accountant at the wonderful widget company needs to figure out how much it costs to make a widget. Meanwhile, the service manager for the widget repair service needs to know what it costs to fix a widget. Sounds easy, but it's not. When it comes to making and repairing widgets, there are basically two kinds of costs, direct costs and indirect costs, also known as overhead. Direct costs are directly associated with making or repairing widgets. Things like the cost of raw materials that go into the product. Or in the case of the repair service, the wages of the repair technicians. Indirect costs or overhead are costs that cannot be easily traced to a product or service. Electricity, maintenance, insurance, and depreciation are some examples. Direct costs are relatively easy to assign. For example, what is the direct labor cost to make 100 widgets? Well, let's say it takes 2 workers a half hour each to make 1 widget. At an hourly rate of $10, that's a direct labor cost of $10 to make a widget. The direct labor cost to make 100 widgets is, well, you get the picture. Indirect costs or overhead are trickier. How much, for instance, of the depreciation of the factory machinery should be allocated to the cost of producing a widget? Or, for that matter, how much of the repair service manager's $45,000 a year salary can be allocated to the cost of repairing the widget? It's hard to say, right? But the cost accountant for the wonderful widget company must find the best way to allocate these indirect product costs to the cost of making a widget. The good news is that there are many different methods for allocating indirect costs to products and services. The bad news is that these different cost allocation methods can yield quite different results, some of which may be more realistic than others. But making sense of difficult to quantify costs is part of the challenge that managerial accountants face. And believe it or not, it's part of the fun.
I don't know. You think she's right when she says it's part of the fun? Allocating overhead is particularly challenging. Direct materials, direct labor. Companies have gotten pretty sophisticated with technology and how they can track things. So we're going to spend, this is chapter 2, and we're going to spend quite a bit of time. This is kind of like the foundation again for much of what we do this semester. So with that said, yeah, I'm plunging into chapter 2. We kind of, I gave you an introduction to it on Wednesday, and let's roll up our sleeves and talk about direct materials, direct labor, overhead. Before I jump in and put a whole bunch of T accounts, I'm used to doing this on the board. I'm not used to doing T accounts on the computer, so, bear with me. I'll get better as I go. This class, what would be direct labor or indirect labor for this class? If this class were a cost object, remember that word, cost object? And a cost object could be a product, it could be a department. I know in 202 I focus a lot on cost objects being products, but it could be a division unit. And something that's a direct cost for one thing is not necessarily a direct cost for other things. So it's kind of a flexible term. What would be a direct cost for this class? Or an indirect, labor. Let's talk about labor. Indirect labor or direct labor. And hey, if you're out there, you've got microphones, so feel free to chime in so I don't pick on 4 people sitting in front of me. Or feel free to use the chat. Labor, direct costs, indirect costs, if this class were the cost object.
Would direct labor, could that be like the professor teaching?
Yeah, that's me. So I am standing here from 9 to 9:50. You could directly trace me to this class. So yeah, I'm your direct labor. Is there any indirect labor involved?
Is indirect labor us, like the students, or no? Or is that more like the people who are in the campus that are doing like maintenance and stuff?
So I'll answer the first question. Don't take this the wrong way, but you don't count.
That's fine, that's better.
Because you're the revenue side.
Oh, okay.
But yes, you mentioned maintenance. Yes, absolutely. They're maintaining this building. I have no idea what, if you broke it out into all the different classes, how much would be assigned? You notice I used the word assigned or allocated. Assigned, allocated. We'd have to come up with some estimate in the beginning, right? Come up with an estimated cost driver. Remember those terms? What's driving up the cost of maintenance? And we'd have to allocate it. That's indirect labor. So, yeah, classic example. I used to give handouts. I don't give handouts anymore. That would be direct. I mean, I go to the Xerox machine, they count how many handouts. Yes, I have 3 classes, but that would be easy enough to figure out and directly trace. Now, some things, it's just not worth it. They're not significant. I mean, nails, screws, yes, they directly go into the product, but I mean, staples, are we really going to sit here and be measuring that stuff out? No, it would be crazy to do that. But, there's other things, if they could easily track how many handouts I'm giving you all. I mean, handouts might actually be more indirect, but overhead, is there any overhead attached to this class? You're kind of sitting in an overhead room, right? I mean, think about it. We've got maybe heat this morning because it's a little chilly out. We've got the lights on. We've got property taxes on this building, insurance on this building. Is that overhead? If this is like the equivalent to the factory. This is where this is our main product here. I mean, we're not a manufacturer, but if we're talking about, well, let's talk about depreciation on this building. We've got offices right behind this wall. We have offices. Is all the depreciation on this building part of product cost? Product cost is another word for inventory. Why'd I point out the offices? I ask too many questions on a Friday, don't I? I mean, I jump, I'm on my second cup of coffee, so I'm just full of questions. I'm too awake. Plus, I probably went to sleep much earlier than you did last night. Perhaps, I don't know. Earlier than some of you, I'll say it that way. Depreciation on this building. Is it all overhead? And the answer is no. It's not all overhead. Can anyone explain that statement?
Only the like parts of the building connected to your class be considered overhead for the product?
That is a good answer, because anything office related is not a product cost, it's a period cost. So product cost, I'm just kind of giving you a little introductory refresher. Product cost is inventory, direct materials, direct labor, and overhead. Should I take notes? Product costs, yeah, why not take notes? Yeah, I want to do T accounts, so I might as well take notes over here. So product costs, period costs. Let's just kind of back up and do a little review. Your product costs, so your direct material, plus your direct labor, plus your, well, manufacturing overhead. Sometimes it'll say factory overhead. So, they mean the same thing. Period costs, 2 things. Do you remember what 2 things go under period costs? One starts with an S and one starts with an A.
Sales and administration.
I'll take that one, the A1, administrative, right? Administrative costs.
Sales.
And, well, that's the revenue side. Well, actually, Two of you said sales. So you know what? Technically, I should say you're right, but which side of sales? Thank you, selling, right? I mean, it's JU that's doing the selling. So yes, sales, but not as the customer, as the company that's, yeah, administrative. And you know what? Why don't I just say expenses? Because these are expensed in the same period, administrative expenses and selling and expenses. That's why they're called period costs, because they're expensed in the same period in which you incur them, right? Here's inventory. So product cost, another word for product cost is inventory. Is it an expense? Trick question. Kind of. Not really. Inventory is an asset, right? So is it an expense? Can it ever be an expense?
Doesn't it
Too many
become
questions.
cost of goods sold when it's sold?
All right, let's do that. It becomes cost of goods sold when it's cost of goods sold, and then it'll go on the balance sheet. Then it'll leave the balance sheet and go on the income statement. So yes, it starts out as inventory. Oh, it doesn't like what I'm doing. It'll eventually become cost of goods sold at a later date. So let's talk about overhead. Indirect materials, right? Plus indirect labor. So those are the small things that we can't directly trace to a product. Plus everything else that relates to the factory, everything else that relates to the factory. And in our case, we're not a manufacturer. We're a product, you know, with anything that relates to teaching. So I used to work as an auditor, and I would be assigned to a client, and the first thing I would do, because this was a long time ago, before we used technology to the extent that we do, I'd go up to the supply room and pack a big, it's kind of like a little miniature suitcase filled with supplies. I'd requisition all the supplies, and I'd have to give them a client number so they could directly trace them to the client. My time, and what I always hated this when I was an auditor, I'd always have to keep track of my time down to 15-minute segments. And at the end of the week or the end of whatever period, I'd have to submit my timesheet and indicate what I was doing at all times. So there was always a client number, and you know, if I wasn't working on a client, it would be like, you know, maybe like some educational thing, but so they could directly trace my time as the auditor to the client. So it doesn't have to be a factory. It can be service related as well. So let's talk about the everything else that relates to the factory. We know what depreciation expense is, right? They could figure that out. The utility bill, I mean, it's a cold January. We may not know what the cost of heating is until we get the bill in February. Does it work that way with overhead? Do we wait until we get all the bills in? Do you know how impractical that would be if we waited until we got all the bills in? So how could we, I mean, we don't want to tell our client, our customer, you know what, I can't give you the exact price yet. Give me a month or two, and then I'll be able to tell you what the price is of the product. Yeah, they'd laugh at us and they'd go to our competition. That's not practical. So how do we get around waiting until we get all the bills in to figure out overhead? Ooh, good word. Estimate. Estimate it, and then allocate it. That's how we deal with overhead. Okay, we'll get into that. Ready to have some fun with this? Yeah. So let's take a look at problem 36. So let's see, problem 36. I have it right here in my Blackboard page somewhere. Get out of this. Yep, I have it in my Blackboard page, chapters 1 to 4. And this is where we're going to be seeing material. And by the way, you might have noticed this one here. So it's not due yet, but there's an Excel assignment from every chapter. And this is one that's from chapter 2. So we could talk about it as it gets closer, but it's from this chapter, and it's through Pearson. Yep, it's through Pearson, so you'll be doing it the same place where you work on your homework. So let me just make sure I don't do that one with you. Nope. Flow of inventoriable costs. So we've got heaters. Well, that's appropriate this morning. And we've got a whole bunch of information here. And they want us to calculate direct materials at the end of the month, fixed manufacturing overhead costs for the month, direct labor costs as of the end, for the month, work in process, cost of goods, cost of finished goods available for sale, and finished goods inventory. So,
yeah. Why are the ones highlighted? Is there something special?
So I must have, yeah, because I can't figure out how to undo that in my book at home.
Like, there was some kind of secret accounting method going on.
No, I must have done a search. And they highlighted them, and I probably just messed up when I copied them onto here. So that's the honest answer. Yeah, but yeah, and probably didn't notice it until, you know, I loaded all of them on here. So, oh well. So let's look at what information is actually given, and let's create some T accounts. So I'm just using Excel for this. We've got raw materials, or sometimes they're called materials. We've got work in process. And that one always takes up the most space because there's a lot that gets written there. And actually, I'm going to move it over. Let me move it over. Let me do this. Work in process. Can I just write WIP and you'll know that that's work in process? Let's try that one more time. There we go. Work in process. Then we've got finished goods. Eventually I'll get it. Okay. There we go. Then we've got finished goods. And those are our product costs. So all of this, these are our product costs. Another word for product cost, inventory. Covers all three of these, 3 different stages of production. So that's all on the balance sheet. Product cost, inventory shows up on the balance sheet. And then eventually we'll move over into cost of goods sold. And at that point, we've moved over to the income statement. Okay, so let's take what we know and plop them into different places. So we've got inventory in the beginning, 105. Then we purchased 365. Give me 1 second just to. And then we've used 385. So what do we have left at the end of the month? Best answer is well, you could just calculate it, or you can plop it in. We started with 105, and we ended, actually, we're trying to figure out what we're ending with, right? So we purchased 365. If you add these two together, that's what, $470 worth of materials? And they're saying that we used 385. So if I want to know what I have left at the end of the month, hopefully this will come back to you. Started with 105, we added 365, and we used up 385. So we're left with $85 worth of materials at the end of the month. So October 31st, Halloween, October 1st. And you start to see the same pattern because everything flows the same way now. So you see this 385? Let's move it over. We've got, oh, that'll do it. Let's move it over because it's direct materials. Over here, 385. So let's plug in what we know, going back to the problem. So we tackled the first three. Total manufacturing overhead costs, $450. Let's talk about total manufacturing overhead costs. Total manufacturing overhead costs, $450. So that's going to consist of, well, you know, because we just talked about it. There we go. Here are our three items, total manufacturing overhead costs. So we know how much material we've used, right? We just have to grab labor and we have to grab overhead. So is the question, they've made it a little bit challenging for us. Oh, I'm sorry. They're giving us total manufacturing overhead costs, right? And our task is to find out fixed manufacturing overhead. So now you've got to throw in one thing I haven't talked about yet. Let's see how on top of things you are on a Friday morning. Best answer for fixed manufacturing overhead costs? Based on the information you have in front of you? Good answer. So they give you the total, and we haven't talked about fixed and variable, but that's part of this chapter. So if the total is 450 and the variable is 265, just subtract and you'll get your fixed manufacturing overhead. So the answer to number one, I'll just highlight them. The answer to number two, well, if you take 450 minus 265, you're going to get 185. So what we've done is we've taken the total minus the variable, and that gives us the fixed manufacturing overhead costs. So we'll get into fixed and variable in this chapter, and that kind of leads later to some further discussion about break-even analysis. All right, so we know that material and direct labor, and I'll just say factory overhead so I don't keep changing the terms. We know that these three things together equal 450, right? Direct material plus direct labor plus factory overhead equals total manufacturing costs equals 450. So perhaps we could plug in what else we know, because the next question is asking us, what's direct manufacturing labor costs? So they're looking for this number here, direct manufacturing labor costs. And we know that the total is 450. So let's plug in what we know. We know direct materials, 385. We don't know direct labor. That's what we're solving for. Do we know manufacturing overhead costs? Yeah, we just talked about that. That's the 450. That's the total, right? And do we know what the grand total is, right? Let's see. Let's see what information they give us. They tell us there's one number I could use here. It's a big number. Oh, wait a second. These three are big numbers. It's not cost of goods sold. We're not up to that. But we've got two things, cost of goods manufactured and total manufacturing costs. Which one of these two do you think I should pop in? So cost of goods manufactured is like a past tense thing. That takes into account what we've actually, it takes into account beginning and ending inventory, right? This takes into account everything we're spending during the month. Pick a number. The right answer is either 1,610 or 1,660. You got a 50-50 chance. And remember I said I never mind a wrong answer unless it's a graded assignment. Yeah, I'll go for that because this is material, labor, and overhead. So 1610 is the total. So solve for direct labor, and direct labor happens to be equal to 775. So direct labor, 775, right over here. Factory overhead, 450. So this is everything we have spent this month, right? Everything we've spent this month during October, and we call that total manufacturing costs. But wait a second, I didn't write that down correctly over here, did I? Let me just, I don't want to write down the wrong thing. Total is 450. Hold on a second. That was total factory overhead. Whoops, sorry. I got to correct that. Shouldn't that be 1,610? Yeah, total manufacturing costs, 1,610. 450 was the factory overhead. That's the nice thing about Excel. I could just get rid of it, except it's recorded. Oh, well. So where does that other number come into play? Because we talked about 1610 and 1660. Well, remember I said this takes into account beginning and ending inventory. So work in process on the 1st, 230. Okay, let's throw that in. 230, work in process, and that was on October 1st. So we walk in the door on October 1st, and we see some goods that are partially complete, $230 worth. We add on during the month, 385, 775, 450. And everything that we can spend this month on the product is costing $1,610. So let's see what they're asking for next. They're asking for, let's see, work in process at the end. All right, so this is the next puzzle to solve, work in process at the end. And there's one number we need to plug in on the other side. And don't get caught up in just numbers. You walk in the door, you've got these partially completed units, you tack on more costs, you want to know what's still left that's partially completed. So what's missing? If it's not partially completed, where did it go? It's a finished good. So at the end of the month, some things are still partially complete. If they're not sitting there, we finish them. And they're going to be called cost of goods manufactured, $1,660. So we plug in $1,660 because we finished those. Can I write CGM, cost of goods manufactured, on this side? And now it's going over here to finished goods. And I know it's going to tell me it doesn't like the way I'm doing things. There we go. All right. Cost of goods manufactured, they're finished, and the key word, the key phrase is the ED at the end of the word, manufactured. We finished them. So solve for ending inventory, and you've got, let's see, we started out with 230. We added 3 more costs, and you know what? Those 3 costs total 1,610, but I guess I'll grab them from here. And we finished working on 1,660. So there's our answer for ending inventory. We're on a roll now. We can't stop here. Cost of finished goods available for sale. Where is that on these T accounts? Let's move over to finished goods. Is it the credit side? Is it the ending inventory side? And let me just get to my bottom here for totals. So again, we are looking for cost of finished goods available for sale. Where in that T account am I going to put them? If they're available for sale at the end of the month, where am I going to put them? And that was my hint to you. At least I got you to smile. I could see that you smiled underneath your mask. I think. Unless you're making faces at me, I don't know. All right, well, let's think about that. Finished goods available for sale. So we still have them, right? Isn't that our ending inventory? Finished goods available for sale. We are looking for this number. So did we have any finished goods when we started? Let's go back to it. Finished goods inventory, 130. You walk in the door, you've got $130 worth of finished goods on October 1st. You added another 1,660, cost of goods manufactured, and that's a key word to keep in mind. Total manufacturing costs, that's a key word to keep in mind. This is fun using colors. And that's what's sitting here. Because if I was writing on a board, I'd circle these 3 and I'd be writing notes. But all right, I could do it this way. We're looking for ending inventory on October 31st. What do we need for this side? What do we call it? It's going to be another key word. Cost. It looks a little bit like this one. Cost of, it's moving over to this side. What?
The cost of goods sold.
Yeah, cost of goods sold.
1770?
The number you said, I'm sorry?
1770 from here, right? Is that what we're using for the finished goods?
So finished goods, ending inventory. You're close. So we started out with 130.
Oh, 1790.
Cost of goods manufactured. Oh, we're looking for cost of goods available for sale. So, all right, lost my spot. Cost of finished goods available for sale. I'm sorry. So we have a total of 130 plus 1,660. That's everything that we could sell. 1,770. But you know what? I'm putting it in the wrong spot. You don't want to put it there. Cost of finished goods available for sale. So we started out with 130. We added another 1,660. We've got a total of 1,790 that we could sell. And we probably have to get one more piece of information from here. We know how much we sold, right? Cost of goods sold, 1,770. So cost of goods sold, 1,770. It looks like our missing piece down here, right, is the 130 plus the 1,660. Whoops, I didn't mean to end it. Minus 1,770. Looks like we have $20 worth of goods left at the end of the month. And cost of goods sold, we're going over to the income statement. We sold it. So if you think about it, you started out with 130 of completely finished goods. You finished working on this stuff, so you moved it over, cost of goods manufactured. So you had a total of 1,790, and you sold 1,770. So that's what you're left with at the end of the month. That's still there. So what's your inventory? What's your inventory at the end of the month? Total ending inventory. What are you going to see on your balance sheet? 85 plus 180 plus 20, whatever that adds up to. That's your total ending inventory, these three categories. Is there anything left from this problem? I think we did it all, didn't we? So I wouldn't have assigned this on your own just yet because they kind of made it into a puzzle. They didn't really give you the pieces very easily, but my hope is that by, discussing this, and I guess I'll throw this here just so you remember, it moved over to the income statement. My hope is that this refreshed, I don't know, was this too easy or did this kind of refresh your memory of days gone by? Let's take a peek at your book, unless you have questions on this problem. So we've talked a little bit about direct and indirect costs today, and illustrating the flow. Okay. That's kind of what I did today, illustrating the flow. And you've got all these great pictures in your book. Oh, that looks a little complicated, but it really isn't. It's what we did today, right? They just lay it all out. So direct materials inventory, right? Work in process, finished goods. They walk you through a similar example. They give you all the terminology again. So we're going to spend quite a bit of time on putting together kind of like a financial statement, and it's going to be step 3, cost of goods manufactured. Because there's a lot that goes into that cost of goods manufactured. So remember, I like T accounts, but you know, I'm a little quirky as an accountant. I like the visuals. You don't have to use T accounts. You could just put together a cost of goods manufactured schedule, and that's what we're going to be doing. But at any point, if you want to just go back to the T accounts, see this piece right here? That's what we're going, I mean, this whole schedule that we're going to be putting together is really this number. And think about what went into this number. We started from here, we worked our way through, and we wound up here. So to me, when I look at T accounts, it looks like, okay, it's a logical flow. If I look at this, I get a little overwhelmed. Let's see. There it is. Schedule of cost of goods manufactured. That bottom number, 104, all it is this piece here. So if you happen to like looking at it this way, wonderful. And it says it's going toward the income statement, cost of goods manufactured. Well, how is that going toward the income statement? Don't we want cost of goods sold on the income statement? And it helps us figure out cost of goods sold. So we've got cost of goods manufactured, which, check it out, direct materials, direct labor, overhead. To figure out a cost of goods manufactured schedule, all it is are these 2 T accounts. To figure out a cost of goods sold, it's this piece. So if you happen to like T accounts, that's all it is. The first 2 T accounts are here, and then on the income statement, you probably are not used to seeing it in detail like this. You probably were just used to seeing revenue less cost of goods sold equals gross margin or gross profit. But now we're throwing in that third T account, that finished goods T account, to kind of build up to it. We can start putting one of these together right now, if you'd like, or I could say absorb what I taught you today.